Well, thank you very much, and good morning, everyone. Well, an Australian economist's proudest boast has been about our 25 years of uninterrupted economic growth and how we were to continue rolling into years 26 and 27 when we'd finally overtake the Netherlands, who has the top slot in terms of the longest economic expansion ever. In fact, I made that claim when I was here this time last year, something I often like to point out to our foreign investors whose own economies have kind of been stuck in the mud in that 10 years or so since the GFC got a lot of them into trouble. Trouble is, of course, there's now a bit of a question mark over that story. The last published economic growth numbers that we saw for the third quarter of last year actually went negative. Very unexpected, has raised a question mark about the resilience of the Australian economic story, and certainly some of the pessimists who've been there for most of the last 25 years have resurfaced along with that. Well, is it all over? Well, in the end, I think the growth slowdown was more of a pothole rather than the start of something more sinister. And the chart here just makes the point. Shows you the history of that 25-year plus expansion, and you can see in that last red bar there the step backwards that we took in the September quarter. But what that chart also tells you is that the occasional negative is not unusual in a long-running economic expansion. I've circled the previous declines there. We've had three others where the economy went backwards, but it did turn out to be one step backwards followed by two steps forward again. So occasional interruptions, they're not unusual. We think that's the way the story will play out this time round. What that negative has also reminded is that the weather matters. A lot of the reason the economy went backwards in the third quarter is because it was wetter than usual. In fact, many parts of the country had either the wettest or the second wettest period since the records began. That had a big negative impact on construction activity around the country and on mining activity in some areas as well. Well, it stopped raining, and so we should see a recovery from that coming through. I think the other lesson to take away from this negative is that the politics also can be very influential from time to time. Now, a lot of what happened in the third quarter of the year was in fact driven by what was happening in June and July last year. And what was happening then? Well, we had a very long-running election campaign, lots of arguments. It took us a while to work out who'd actually won the election, and then there was a lot of uncertainty about the makeup of the Senate and what that might mean for economic policy. And it's not surprising that a lot of businesses and consumers became more cautious at that point, with a real economic effect coming through. But as I say, though, these are all largely temporary factors, and they should be reversed. And we think we returned to positive growth at the end of last year. Now, we've got to have a bit of a look back, obviously, before launching into the future. But we shouldn't get too caught up with the kind of blow-by-blow moves in economic statistics. They are volatile. They do go down as well as up. Our real comfort about why we think we will continue to grow into Australia is because some of the major commodity-related headwinds that have been blowing in Australia, that have been slowing the economy down and creating difficulties for everyone, have pretty much run their course. And this set of charts here it gives you kind of the history of the commodity story in Australia over the last 150 years or so. And it reminds you just how big the boom in commodity prices and the subsequent boom in mining and construction activity were, and equally how far that we've moved from those peak levels a few years ago. So falling mining capital spending, it's been weighing on spending in the economy overall. It's certainly been a negative for jobs. Falling commodity prices has been a huge drag on Australian incomes. And while we haven't hit recession as such, the sort of income growth we've been seeing in Australia in recent years has been the sort of numbers we'd expect to see in a recession. So you could claim perhaps that we've been in an income recession. And that income story, I think, is where the real risks have resided for a while now, particularly when you mix income weakness with the extreme policy settings that have been put in place in Australia and in other countries as well. So when you think about it from a corporate perspective, if you can't generate the sort of revenues you'd hope to see, well, the focus inevitably turns onto costs and controlling those. It's a potential negative for capital spending and labour hiring. Move on to governments, same story. Revenues failed to come through the door the way it was expected, and so the focus, if you want to reduce your budget deficit, is on cutting spending, again, with potential negatives on economic activity. And of course, for households, if your income is only growing slowly, well, it just limits your ability to spend full stop. Then, as I say, we ally that with the kind of financial and policy backdrop we have right now. Well, it's all about how can I get some extra income, and it has encouraged a pursuit of yield. We've all focused on what sort of assets will generate a capital gain, and by doing so, we've all taken more risk onto our balance sheets. So these are the sorts of issues that have tied back to that income story, which in turn ties back to commodities as well. Well, the good news is that commodity prices have actually picked up since their low point last year, and the outlook for incomes has improved, and the drop in mining capital spending is almost complete as well. We heard the Governor of the Reserve Bank say last week, for example, that around about 90% of the decline in mining capital spending is now behind us. A little bit more to come, but that significant headwind to spending in the economy is pretty much blown out. And what all these things mean, in a sense, I think, is it should actually be easier for the Australian economy to grow from here. Now, the point I really want to emphasise is this commodity story, because it is shifting the income dynamics for the Australian economy very substantially. And the chart here makes some of the points. On the left-hand side there, it's the Commonwealth Bank's commodity price index that we construct to reflect our particular commodity mix. And you can see the improvement in prices that has come through. Now, we're a long way below those peak levels of a few years ago, but as of the moment, we're about 46% above the low point that we reached around about this time last year. And where is that, if you like, starting to show up in the income type numbers? Well, the chart on the right-hand side there shows you the trade balance for Australia. And we have moved very quickly in the last few months from running trade deficits of around about $4 billion a month to a trade surplus in December, the latest figures there, of $3.5 billion. That's the biggest trade surplus that we've ever had. But that swing from -4 to +3.5, so $7 billion or so, that's an indication of the extra income now hitting the Australian economy every month, courtesy of the turnaround that we've seen in commodity prices. Now, the next step of the chain here is that we will see that extra income show up in company profits, and some of the results in the current reporting season are starting to reflect that, and it will flow into government revenue as well. And so it will help improve the budget backdrop for Australia, we think. And some of it will trickle down into wages as well, we would expect. Now, I don't want to suggest that the rivers of gold that were flowing in from the commodity boom a few years ago are on their way back by any means. We will see some of the recent increase in commodity prices retrace, we think. But I think we can say pretty confidently that the income recession that has been a big risk in Australia is well and truly over. The question, of course, is, well, if that story is kind of negated itself, if it's run its course, where should we be looking for growth in Australia over the next few years? And I think there are really four key areas that we need to look at. They're where the potential for growth lies. Some of them will be easier to achieve than others, but certainly the opportunities are there. And if I just run through those, well, commodities will remain important. The chart on the left-hand side here, again, just looking at the mining story, well, the blue line shows you the huge increase in Australia's mining capital stock because of all of that investment. Now that it's largely complete, what we're seeing, of course, is that capital stock is now generating a lot of extra iron ore, coal, and soon LNG and the like, and all of that's going to be exported. And the pink line on that chart shows you what's happening with Australia's resource exports. Plenty more upside to come through on that part of the story. I mentioned earlier that it had rained, and that had been a negative for some parts of the economy, like construction, but equally it's a positive for other areas such as agriculture. And so every economist presentation these days comes with a weather chart. You can see mine on the right-hand side there. It might be a bit hard to read, but basically any of those blue bits you can see on that map, those are parts of the country that have had above average rainfall over the key growing season. And it covers most of the country apart from parts of Western Australia. So we're going to see a huge boom in rural production this year. That will go into exports largely as well, and that's going to generate a significant contribution to economic growth, even though the agricultural sector is quite a small part of the country. And we saw only yesterday that the official forecaster for agriculture, the government ABARES body, has lifted again its forecasts for the winter grain crop. They're now saying that we're going to produce something like 59 million tonnes worth of grain, and that's around about 20 million tonnes higher than last year, just to give you an example. That is a lot of extra Weet-Bix, but it will be generating activity and income for the Australian economy. If I move on, the third area where we think we're going to see some growth is in the infrastructure story. We are starting finally to see some positive indications there. And the chart on the left here, it shows you a survey by Deloitte's Access Economics, where they work out the value of all of the committed investment projects in Australia. So these are the ones that have been signed off, they're going to happen. And you can see the big increase towards the end of the chart there, and when you go through the detail, most of that increase is in public-related areas to do with things like transport, and particularly in New South Wales and Victoria. So infrastructure, it's finally coming through. It's going to make a decent contribution to growth again. The other area, I think, with a lot of upside potential is what's happening with incomes in the Asian region. Economic growth rates in Asia have slowed, but incomes are still growing at a very decent pace in the region. And I've just picked China as an example on the chart on the right-hand side here. And so the black line, Chinese GDP growth, it's continued to expand, but at a slower pace. But those other lines just show you different measures of income in China, and they're all growing at a faster rate. And it's that income growth that is generating the opportunities for Australia. There's a lot more people that would be characterised as kind of middle income earners these days in the Asian region. So there's a lot more spending on goods and services by that group. Well, where does it go? Well, it certainly goes into things like larger and better quality housing, more and better quality food, consumer durables. And on the services front, where we can see some clear signs of progress here in Australia, it's things like tourism and education. This is where the opportunities will lie, and just one example of the upside to this part of the story. I think our China economist tells me that around about 5% of the population in China have a passport. Well, the other 95% get a passport. You can only imagine the upside to the tourism story, for example. Now, if I put some numbers on this, well, resource exports, we think that'll add about 1% to growth. The farm boom, that's worth about 0.5% to GDP growth. If we throw in the infrastructure story, around about 0.5%. Asian income story, tourism, education, around about 0.5 to 0.75%. Trouble is, though, we've got to give some of that back. There is a little bit more of the drop in mining capital spending to come through, and it does look like the residential construction boom that's been a very big generator of activity and jobs in the last few years is approaching a peak. So if you add all these things up, you get to around about 2%. Now, we'd regard normal growth in Australia as around about 2.75%, so we do need to see something else happen to fill in that gap to get up to our potential growth rate. So what's needed to generate that extra growth? Well, I think in Australia's case, it needs to come from government and business, if I can put it into those broad categories. And there are certainly opportunities for both. While there is more money being spent on infrastructure, the chart on the left-hand side gives you a bit of an idea of just how big the task that we're facing. So it shows you the size of Australia's capital stock, so the value of all the roads, railways, ports, factories, schools, universities, and the like. And I've broken it down into kind of rough groups there. But what you can see is that our economic infrastructure, our social infrastructure, relative to the size of the economy, is around about where it was back in the 1970s. So there's clearly plenty of room there for expansion and improvement. For that to happen, though, I think governments need to lose their fear of debt. The one thing we know about infrastructure spending is that it does generate very large returns, and certainly returns that are typically well in excess of the cost of borrowing there. So we do need to see governments push further on with this infrastructure task, even if it does mean more borrowing, even if it does raise some risks to our much vaunted AAA rating. It adds to demand in the short term, and we need some of that to get up to that 2.75% number that I mentioned, but it also boosts productivity and income over the longer haul, again something the Australian economy needs to see. Likewise, we would like to see businesses outside of the mining sector push on with their own investment task, and one of the things we need to see there, I think, is a greater appreciation of the new reality, if you like. The fact is, it is going to be a low income, low yield, low return environment, really. And in that case, when you look at the chart on the right-hand side, having hurdle rates of returns for evaluating investment projects of somewhere between 10 and 16% just looks too high. So some greater realism there, I think, in a sense, would help us get to that 3% number as well. Now, having just finished the start of the Lunar New Year. In fact, on Monday I was in this very room speaking at a Lunar New Year dinner, where there was a very nice Ferrari in the far corner over there as well, but that's unfortunately gone. But there is kind of one other rooster that we do need to think about in the year of the rooster, and of course that is President Trump, who's already had a very big impact on financial markets around the world, and certainly is likely to have a big impact on economic activity in the US and elsewhere as well. Now, from a market perspective, there's something that developed that's been called the Trump trade, and that is every time we get a positive tweet from the White House, then typically what happens is US share prices go up, US bond yields go up, and the US dollar strengthens. Equally, when we see some of the more contentious tweets coming out, that trade are reversed. So what it indicates, of course, it is going to be a very volatile backdrop for financial markets this year. When we turn to the economic side, well, we think Trump's policies will be expansionary for the US economy, and they'll also be inflationary, partly because of that. So we're probably going to see US interest rates rise more than they would have done otherwise. So in our businesses, we should certainly be prepared for a higher level of interest rates as we move through 2017 and beyond. What's also very clear is that tax reform will become important. There is a degree of tax competition coming through. We know that something will be happening in the US, and President Trump has tweeted that it's going to be phenomenal, but that's as much as we know about the tax package. But it seems pretty clear in a few weeks' time we'll be seeing something that's quite significant on that front, and something that's going to change again the business environment for everybody. The biggest risk, though, is maybe what happens on the trade front. It does appear there's real risks here of trade and currency wars emerging as everybody fights for market shares, as trade barriers perhaps go up again. Well, I can really say there is, I think, like any war, nobody really wins. It's not a desirable outcome, but one risk that we should be prepared for. I just want to pick on one aspect of the story there, higher interest rates, and while they may go up from where they are now, it is going to be an environment, I think, where interest rates will remain low overall by any kind of historical standard. Now, I like long-run charts, and this is the longest one in my collection. It shows you the history of interest rates over the last 5,000 years. It was some work done by the Bank of England to prove that interest rates today have never been this low, and they succeeded in doing that. But what they also succeeded, I think, is if we ignore that period on the left-hand side during the Babylonian Empire, the reality is that period of very high interest rates that we saw between the mid-70s and the mid-90s is the aberration. Low interest rates are, in fact, the norm. Maybe higher than now, but we're certainly not going back to those sort of levels that we did regard as normal back then. So we need to be ready for that, and what it implies, I think, from a big picture sense, is that lifting household wealth, well, it's going to require an increase of savings out of income rather than relying on capital gains or higher house prices and the like to drive that. For businesses, well, lifting profits is all going to be about focusing on growth and productivity, I think. So certainly a longer-term story there to keep in mind. Now, I mentioned the Chinese Lunar New Year, and there are 12 animals in the Chinese zodiac. I want to finish off on a 13th animal that we should all think about today, and that is the elephant. Now, this chart shows you something called the elephant curve. There's a quick hint about why it's called the elephant curve. But what this chart actually shows you is that it looks at income growth over the 20 years up to 2008, so when Lehman's got into trouble and the whole global financial crisis got underway. The way to read that chart is the further to the left you are, the poorer you are, and the further to the right, the higher you are. And what it shows is most groups went ahead at a decent rate over that 20-year period. But there is a group in that kind of 70 to 85th percentile which went really nowhere through the period. And that is actually where most of the middle income earners in the advanced economies sit. So you've got a very large group sitting there who feel they've gone backwards in a sense, and certainly haven't received any benefits from all of the much vaunted reforms that politicians and economists like to talk about. So you've got a very large section of the global community, if you like, who are disillusioned by the whole process and some of the surprising outcomes that we've seen over the last year or so, like Brexit and so on, are no doubt a reflection of this. And I'll highlight that point because I suspect this year won't be any different. The reality is there's a whole series of very important elections coming up in Europe. For example, Brexit will begin in earnest. So again, I think the message to take away today really is volatility from a financial market perspective and perhaps expect the unexpected. Now, I'll stop at that point and thank you very much for your time today.